Nashtoa interviewer.
Niseme nini? Simnipatie intro. Ladies and gents, welcome back to another episode of SOKOSimple, sponsored by NSE SOKOPlay. We take a deep dive into the financial market, and today we're talking about derivatives. And who best to talk about it than none other than the super broker himself, Mr. Superman when it comes to derivatives. Mr. Anthony. Please introduce yourself.
Hello everyone, my name is Anthony Kembati, equities and derivatives trader from AIB Axis Africa, and I'm glad to be here today. So cheers.
So Mr. Anthony, tell us something about yourself.
Okay, so there's a lot to say about myself, but in summary, I'm passionate about music, and I'm also passionate about the financial markets. And I'm really excited to be here because I really love educating people and sharing my knowledge. Yeah.
Right, so you mentioned about music. Can you talk about that one?
There's a lot we can talk about. Do you have the whole day?
Please, can my manager approve it? Go ahead.
So when it comes to music, I've actually done music for the past 10 years. I play the trumpet. And in terms of the specific genres that I like, I'm a huge fan of Afrobeats and R&B.
Okay.
I would also say I'm more of an old soul compared to what the younger people are listening to today.
Okay, so when you say old soul, are you talking about the 80s, 90s, early 2000s?
More of the 80s, the 90s. So I'd say, in summary, Michael Jackson, Whitney Houston, Mariah Carey, and of course the boy bands of the 80s and the 90s.
Boys to Men.
Boys to Men,
So how did you transition from music to finance?
It was actually an interesting story. So it's a normal story of a normal campus boy in school. You're broke, you're trying to look for money. And some of my friends were actually doing Forex at the time.
Forex?
Yeah. So it's a funny story. So the girls we were with in school used to come and tell us, you guys, you see your friends are making money, you guys are just sleeping in school and all that. The pressure. So there were a lot of rumors about the guys. So they were like, the guys have bought cars, everything. A lot of rumors, which are not true. And so I got interested. I approached one of the friends and I was like, hey, I've heard what guys are saying about you guys, and I think I'm interested in learning this thing. So he was like, you sure? I was like, yes, I'm so sure about it. So he decided to teach me Forex, and that's where I started. So I started Forex, but what I did, which is part of my personality, is when I decided to do something, I'd go in fully. So I started learning Forex, and decided to go deep and learn everything there is about the financial market. So that's Forex, crypto, the fundamentals of the markets, global macros, everything you can learn about the markets. And then from there, I got an internship opportunity at the company I work at the moment, and that's where everything morphed into what I am right now.
And where do you work currently?
AIB Axis Africa.
Hey, shut up. So now, over here, have you heard about SOKOSimple or the NSE SOKOPlay?
Yeah, I've heard it. I've heard about it. I was actually asking about it because I was like, I've heard about Empower Her. So I was asking, is this the male version of Empower Her? So that was kind of funny. So I was like, is SOKOSimple the male version of Empower Her?
Well, is it? Is it? I guess we'll find out. So now, NSE SOKOPlay is basically a virtual trading platform, a simulator which normally you're a broker. So you understand the market, you've seen the back-end system, which is complex. But then now, SOKOPlay, it's basically a simulator of what happens in the back-end, but then now we've simplified it. We've kept a proper user interface, user experience, proper dashboards, chatting experiences. So it will enable the youth or anyone who's interested to join in to learn the ropes, practice, and then now trade. But not with real money, with virtual money.
Okay, interesting.
So, Anthony, today we're talking about derivatives.
Okay.
Are you ready?
100%.
You're born ready. I can tell. Over there, just a quick spoiler. There was an investment challenge which happened for derivatives, and The main reason why he's a super broker is he emerged the number one out of all your competitors. He will feel aje.
I was happy, but at the same time, I think I expected it because we really put too much effort.
Yani you're born ready.
Yeah.
So the first question which I'm going to ask you is very simple. Let's start simple. What are derivatives? And could you give us some examples?
Okay. So by definition on paper, a derivative is basically a financial instrument that derives its value from the performance of an underlying asset. Okay, so it derives its value from the performance of an underlying asset, and in this case, the underlying asset could be a stock, it could be a bond, it could be a commodity, it could be interest rates, many things. So basically, the underlying asset is the stock, and then the derivative derives its value from the underlying asset. So let me give you a quick example. So in our markets, we have, let's say, Safaricom futures, right? So the Safaricom futures derive their value from the performance of the underlying stock, which is Safaricom. Yeah. So in terms of types, the types of derivatives, we have 4 major types. So we have futures, we have forwards, we have swaps, and we have options. Okay, so I don't know if you want me to go deeper into the definitions of...
Do you?
Okay, so let me start with futures because that's what we have in our market currently. So a future is basically a legally binding agreement where counterparties agree to exchange the underlying assets at a predetermined future date and price. Okay, so it's a legally binding agreement where a buyer and a seller agree to exchange the underlying asset at a predetermined future date and price. And the thing about futures is that futures are more they're standardized and they're usually exchange traded, so that they're standardized and they're traded on an exchange. So from that, I think I can see equal to forwards, because the definition for forwards is the same thing. The only difference for forwards is that forwards are usually traded over the counter, what we call OTC, right? So that's the definition for futures and forwards. Then from there we have options. So options are basically contracts that give the owner the right but not the obligation. Okay, so these are contracts that give the owner, the holder of that option, the right but not the obligation to exchange or to purchase or sell the underlying assets at a future date at a specific price that we call the strike price. So the contracts give the holder of the option the right but not the obligation to either buy or sell the underlying asset on a future date, which could be before the expiration date or on the expiration date at a specific price that we call the strike price. Okay. Then finally we have the swaps. Swaps are usually more complex compared to the 3 that I've mentioned, and swaps are usually defined as these are contracts where two counterparties exchange cash flows, and they're mostly used as a risk management tool.
Okay.
Yeah. One of the most common types of swaps are what we call the credit default swaps. They became really popular after the market crash of 2008 because there were huge reasons why that market crash happened. Yeah, so basically they involve the exchange of liabilities or cash flows. Yeah.
So that was a textbook answer.
Yeah.
But now if you were to simplify it for a layman, how would you describe it?
Okay, so a derivative is basically, I think I tried to make it easy as possible. So basically we have a product that's made to sort of emulate another product, which is the underlying asset. So if we have a farmer who is farming, let's say, coffee, we have the coffee, the product, and then we have the coffee futures, which are now the derivatives. Okay, so there are two people. So you can trade coffee without actually owning coffee. So you are trading coffee futures. And in this case, we can have a speculator who is trading coffee futures. So what they're doing is they're speculating on the price of coffee without actually owning coffee. Okay, so if the price of coffee moves from, let's say, 80 bob per kg to 85 bob per kg, the speculator will earn money on coffee futures without actually owning coffee. So that's what we call derivatives. Okay,
so
yeah,
kama yours, it's like lipa baadaye.
Not really. I think it's more of, I would say, I don't know if this is the right word, it's more of like a synthetic product of the underlying product, because remember, you're not owning the underlying product, you're trying to speculate on the price of the underlying product, which in this case could be coffee, it could be Safaricom shares. So instead of owning the actual shares, so if it's Safaricom shares, you're not getting dividends, you're not getting all that, you're just speculating on the price. So it's I think the simplest way I can define the product, the derivatives product, it's a product created on top of another product to emulate the performance of another product.
Okay. Yeah. So how do people make money off derivatives?
Okay. So how people make money off derivatives is they enter into this contract, and this contract, let's say futures, there's a price, a predetermined price for future date. So what happens is, let's say Anthony, you're Sammy, we're entering into a contract, right? So we have different opinions. I believe the price of Safaricom, or maybe coffee, let's use Safaricom in this case. I believe in the next 3 months, the price of Safaricom will move from, let's say, 14 to 20, okay? So I believe the price will go up. On the other end, you are of the contrary opinion. You believe that the price of Safaricom will go from 14 to 10. Okay, so we enter into an agreement, and I take a long contract. Okay, so when I'm taking the long, we call it a long contract, is I believe in the next 3 months, upon expiry of that contract, the price of Safaricom will be above 14, at least 20, right? And on your end, you believe that in the next 3 months, the price of Safaricom will be below 14. So you take a short contract, okay? So I take a long contract, you take a short contract. So we exchange, right? After 3 months, it's 3 months now, the price of Safaricom is at 17, okay? I make money,
I lose
money.
Okay.
So that's, I think what I've just described, speculation, but we'll also talk about the other part of derivatives, or use of derivatives, which is hedging.
Okay. Second question. How have derivatives been utilized in the Kenyan market? And what are some specific examples of how they're applied in their local industries?
Okay, that's a very good question, because I have so much to say about that. So our derivatives market is, I would say, a young market. Was established in 2019. And so far what we have is we have the single stock futures, where people speculate on the price. Okay, where people speculate on the price. I think that shows where I come from. Where people
clearly.
Where people speculate on the price of Safaricom, Equity, KCB. You can actually speculate on the price of some blue chip stocks that are traded on the NSE. And then we also have the equity index futures for the NSE 25. So that's what we have at the moment. But you asked me a question about the use case for various participants or various people in the country. So I'm going to start with what has already been done. A good example is Kenya Airways. They actually used derivatives, I think, for the period of around 2012, 2013, 2014. And in this period, what happens is, for many airlines across the world, one of their biggest expenses is actually fuel, right? Fuel accounts for a big chunk of their operating expenses, right? And remember, we talked about derivatives, and one of the uses of derivatives is hedging and actually reducing risk, right? So what the airlines do is they enter into derivatives contracts, be it futures, be it options, to try and hedge the price, or try and hedge the price of fuel, so that they can ensure that in the next 3 months, in the next 6 months, they can protect themselves from any fluctuations in the energy markets, right? So let me give an example. Around 2012 to 2014, Kenya Airways was very active in the derivatives market, where they were hedging their oil prices, the fuel prices, so that they can have more predictable and stable and predictable operational expenses as far as fuel is concerned, right? So the good thing about that is you can be able to lock in the price. Remember, we talked about futures, where you can be able to lock in the price way in advance, right? So you can say that in the next, we are looking for to be buying fuel. So we want to buy fuel at a fixed price of maybe $80 a barrel, right? So that ensures that even when you're doing your reporting, when you're planning for that, you have a locked-in price, and when that time comes, you guys will purchase that fuel at that price. So you might find that in a situation where, let's say, fuel has gone to maybe $90 a barrel or $100 a barrel, you guys will still buy at $80 a barrel because you entered into a futures contract, which is legally binding. So you're able to control the price. On the flip side, though, it can be detrimental at the same time, because if fuel goes down now to $60 a barrel, you still have to buy at $80 a barrel. And that was one of the huge issues that Kenya Airways faced. And at some point, they decided to stop that and shift to maybe using options, other types of derivatives. Actually, some airlines at some point decided to stop using derivatives at all in hedging fuel. Yeah, but it's a good practice. Yeah. Okay, I've talked about airlines. Let me also talk about farmers. We have coffee farmers, we have tea farmers, we have wheat farmers, and how they can use derivatives to maybe hedge the prices of their crops, right? So what happens is, and we're looking forward to having agricultural derivatives in the future, and in this case, maybe futures, commodity futures for crops like, let's say, tea, like wheat. So what happens is, a farmer who is looking to harvest in the next 3 months, in the next 6 months, they might be like, I've already accounted for the production cost of my crops. I know this is how much I need to produce, and then they have already put a little markup for the profits, and they're like, in the next if I can get maybe 50 Kenyan shillings per kg for my crops, that would be enough for me to cover production costs and the profits. So what they would do is, I'm not sure in the next 3 months or during harvest time, I'll get that 50 Kenyan shillings. Maybe the price might be low, it might be 40. You don't know what might happen, the weather conditions, the global market demand. So what they'll do, they'll take a futures contract and lock in the price of their crops, such that in the next 6 months, I'll sell my crops at 50 Kenyan shillings, right? So let's say it's now 6 months, they've harvested, the price in the global market, the demand is, maybe people are buying at 40 Kenyan shillings, you see? That difference of 10 Kenyan shillings will offset the loss they could have made. But at the same time, remember the same thing, the same story I talked about, the airline and fuel. If the price of the crops now, the market price is at 60, you see, they'll miss out on the profit they would have made. But at the same time, the focus of most farmers would be hedging. So they're not concerned about the profits. They just want to have stable prices and stable incomes, right? So they can be able to know that in the next 6 months, I'll get this for my crops. This also goes to help with their credit worthiness, because if you can go to a bank and tell them, I'm sure that in the next 6 months, this is the income I'll get, then it becomes easier to give loans to these farmers. Okay? Yeah.
Okay, so if you're involved in the Kenyan financial market, or you have insights about this topic, give us a call, and we'd really love to hear what you have to say about this. Now, the follow-up question which I have for you, it's now about hedging versus speculation.
Yeah.
Derivatives can be used for hedging, aka reducing risk, or speculation. That's basically betting on the price movement, as we've explained earlier. So, can you explain the difference between using derivatives for hedging and for speculation?
Okay. So, putting it simply, hedging is some form of insurance, while at the same time, on the other end, speculation is sort of like betting on the prices, right? So let me use the examples I've used before. So the farmer who is entering into a futures contract to protect himself from price fluctuations is hedging, right? On the other end, the other person on the other end who's entering into that contract could be a speculator. So for them, they're not concerned with whatever happens to coffee. They don't care about coffee. They don't care what happens to the coffee production, all that. They're only concerned with the price movement. So for them, they're like, I have a feeling, or according to my research, in the next 6 months, the price of coffee will have gone from 80 maybe to 90. Okay, so that's a speculator. Let me give another example for using Safaricom shares, right? So there's someone who owns Safaricom shares and the prices of Safaricom maybe are going down, okay? So how would they hedge that portfolio? So they have Safaricom shares. What they would do is they would go to the derivatives market and take an opposite position to what they have. See, they have Safaricom shares. They can go to the derivatives market and short Safaricom futures, okay? So when the price of Safaricom goes down, the price of the futures goes up because they were short. So the losses they are making in the spot market are offset by the gains in the futures market. On the other end, there's someone who doesn't own Safaricom shares. They don't care about Safaricom shares. They're only concerned with the price movement. So for them, they're like, Safaricom is likely to move from 14 to 20. They want to make that difference, that 6 bob difference. So for that person is a speculator. But the person who is taking a position to protect an already existing position is a hedger. Yeah.
Okay. So for the people who are watching, we can have a quick poll for you guys. Do you think derivatives should be on the hedging bit or the speculation? Speculation. Sorry.
That's actually a good point of view because it's a huge point of discussion that people have had in their markets, because most people are of the opinion that we should only use derivatives to hedge, not to speculate. Okay. But I think speculation, hedging, they all help to broaden the market and expand the activity in the market.
Okay. Yeah. Now we can also put it on a vote.
Definitely.
For the people saying hedging, say aye.
Aye.
Speculation, say nay. The ayes have it.
The ayes have it, yeah.
Now, in Kenya, derivatives like future contracts can be used by farmers to lock in prices for their crops, potentially stabilizing their income. Now, what impact do derivatives have on local farmers in Kenya?
Okay, so I think I'd already touched on that, but I think I can talk more about it. So the impacts touch on, first of all, risk management, because remember, you're in agriculture, and of course the risks are huge. We have the risk of price fluctuations in the market due to global market demand. We also have the risk of weather conditions, right? And also supply chain issues. And what happens is the moment farmers have products such as commodity derivatives, maybe futures, to lock in the prices of their crops, then most of these risks are sorted out, right? So as a result, we get several advantages, such as there's some sort of stability and predictability of their income. So they're able to predict, in the next 6 months, I'll get this income, right? And also at the same time, they're able to protect themselves from adverse risks. I remember there was a time I was watching the news and the farmers were complaining, the maize farmers, they were complaining that they were given bad seeds and now the harvest is bad and they don't know what to do. Most of them had taken loans to buy products to do their production activities, you see. So, but if they had futures to hedge their crops, then it would be a different story, because you've already hedged your crops, so you don't have the worry of what happens in a situation where I get a bad harvest, right? Okay, and then finally, I think it's what I talked about, their credit worthiness, because for banks or credit providers, one of the major issues they have is this person who wants to borrow worthy to give the loan to. So, and for farmers, maybe there might be the risk of, we don't know what will happen to his harvest, right? Should we go ahead and give him a loan? But if the farmer can come to the bank and tell them, I've already locked in the prices of my crops, I already know this is what I'll earn, give me the loan, because I have some surety in what I'll be able to earn, right? Mm-hmm. Yeah.
Okay, so farmers and agricultural experts, we'd like to hear from you. Share your experiences with derivatives if you have any, but just in case you have any more questions, feel free to ask. What is the current regulatory environment for derivatives trading in Kenya? And how do these regulations impact market participants and the strategies?
Okay, just like all just like all participants in the capital markets, the derivatives market is actually regulated by the Capital Markets Authority of Kenya, and the regulations are stipulated in the Capital Markets, into brackets, the Derivatives Market Regulations of 2015 that fall under the Capital Markets Act, Chapter 485A. And this acts as the primary legal framework for the derivatives market, and it mostly touches on a few segments, be it compliance requirements, licensing, etc., risk management, and also market conduct, how people should conduct themselves, how the various participants should conduct themselves. So touching on compliance requirements, I think all market participants should get a license from CMA. And there are various requirements that are put in place to ensure that, be it if it's the exchange, if it's the clearing members, if it's the trading participants, they all have some requirements that they should meet before being allowed to participate in the market, right? On to the second one, risk management. There are various regulations that have been put in place to ensure that there's adequate risk management in the markets. Because remember, we are talking about derivatives here, and the risk involved in derivatives is high, right? It's a high risk, high reward industry, right? And talking more about that, when it comes to risk, we have several risk management tools that have been put in place. So we have what we call the margin requirements, and under margin requirements, we have the initial margin, we have the additional margin, we have the variation margin, we have the house margin. I'll not talk a lot about that, just to keep it simple. We also have what we call a tiered ecosystem. And what I mean by a tiered ecosystem, we have an ecosystem where all participants have a specific role. So starting from the exchange itself, we have the clearing house, we have the clearing members, we have the trading members, and then we have the client. So it's more of a tiered ecosystem. On top of that, now the makers of these regulations had already imagined or foresaw a situation where maybe you have a default, right? So in case of a default, we have what we call some fidelity funds, right? So we have the Settlement Guarantee Fund, we call it the SGF. We also have the Investor Protection Fund, we call it the IPF. And these funds are put in place as a mechanism of last resort in a case where default happens. We also have a waterfall system that guides what should happen in case of default happens. Also going back to the tire system, the tire ecosystem I talked about. So we have various responsibilities for the various participants. So in terms of, let's say, the clearinghouse is there to ensure that they oversee efficient clearing and settlement. This is to avoid counterparty risk, right? Because counterparty risk is a huge issue of concern in the derivatives market. So to ensure that we don't have counterparty risk, we have the clearing house, we have the clearing members. Also talking about the margins that I had talked about. So we have the initial margin, which is collected by the clearing house, which acts as a surety in case, just to protect the clearing house. We have the additional margin, which is collected by the clearing members. And then we have the house margin, which is usually a percentage of the deposit that clients deposit, which is held back by the trading members. So it's like 10% of the amount we deposit is held back to ensure that no matter what happens, we have some backup, right? And of course, we have the normal circuit breakers in the market, the 10% limit. The prices can't exceed 10% in a specific trading day. Yeah.
Content. Who's this guy? Super broker. Super broker Anthony.
Yes.
He's on content.
Yeah.
Well, so just become the teacher. Wallahi.
Manifesting. Yeah.
So now that we've answered that question, we won't get to even ask you the other one.
Okay.
The next one. Are you ready? I mean, of course you are.
Always ready.
Ish. How about the questions I sent in earlier? Will you revise? So, you already know that the derivatives market in Kenya is evolving, right? With potential new products coming in, and there's also increased participation. we've been seeing the turnover has been going up of late. Crazy margins. We're even pulling out turnovers which are worth 2 million, 4 million. Record breaking. So, what do you think the future holds for derivatives in Kenya? And are there any emerging trends or new products that could be used to shape the market?
Okay, that's a very interesting question, actually based on what we've seen in the past. As I had said, the market is quite young. We started in 2019, but so far, based on what we've been able to achieve, I think you can already tell that the future is really bright for our markets. In 2019, when we were starting out, we just had a few contracts for a few stocks, but now we've been able to expand to 10 contracts. That's the single stock futures. And we also have the NSE 25, the index futures. So moving forward, some of the factors that are going to influence how the derivatives market performs or the trends are going to include, first of all, expansion of the products that we have. As I had mentioned, we only have futures at the moment, single stock futures and the index futures. So product expansion. And then we'll also have a lot of technology advancements, especially around the trading apps. So at the moment, if you want to trade derivatives, you need to have a link to access the trading platform called Avento, right? So in the future, we're looking at a scenario where you have an app that makes trading efficient, fast, and easy for the clients. Hence, this is meant to promote market growth, right? Circling back to what I talked about, product expansion. I've already mentioned the use case of derivatives in our markets, and I think by now you can see that there's a huge gap in terms of the needs that the people have and the products that we have, right? So we in the near future we're going to have options on futures. We might also have commodity futures, that's agricultural futures, maybe derivatives on tea, derivatives on coffee, derivatives on wheat, right? At the same time, people have been talking about the currency fluctuations that we've been seeing with our currency. Why can't we have currency swaps, right? Currency swaps, just to try and help importers and exporters to hedge their products and to make sure that they avoid currency risk and also interest rate risk, all those things. So we have a lot of space for new products in our markets, and I think these are some of the factors that are going to influence where we are 10 years from now, right? Another thing I think I should mention is regional expansion. At the moment, we have the derivatives market in Kenya. So we might have regional expansion to the East African region and have a joint market where Kenyan investors can invest in Tanzanian futures, Ugandan futures, right? And remember, I talked about agricultural commodities futures, right? So let's say Ghana, they have their commodities, right? Tanzania have their commodities. Ethiopia have their coffee, right? Why can't Kenyan investors invest in Ethiopian coffee? Why can't Kenyan investors invest in Ghanaian futures, agricultural products, right? A final one would be a lot of education, client education, just to try and give this knowledge to the people so that people have that knowledge that I don't have to invest in land alone, invest in real estate alone. I have the option to invest in, or rather to trade in futures, options, swaps, and many other. Yeah.
So ladies and gentlemen, feel free to share your ideas and predictions through our social media platforms, and we'll be able to interact with the most interesting ones on our next episode. So once again, Anthony, as we come into our conclusion, once again, this is SOKOSimple, brought to you by NSE SOKOPlay, the NSE's virtual trading platform which enables you to learn, practice, and trade. Thank you for coming through. Aim said, this guy has content. Content for days.
Yeah, it's important to know your products.
Let's take it back. You know, this is someone who started with music,
yeah,
and now is in the finance industry.
Yeah.
Ish, Sasa. Anthony, thank you very much. Thank you for coming.
Okay, thank you so much.
No problem. Hey, where's the bell? Where's the bell? Oh, sorry guys, there's no bell today, but thank you.
We can ring a virtual bell.